Welcome to Money Isn't Everything. I'm Mary Wisniewski, Cornerstone Advisors editor-at-large and host of the show that explores early-stage ideas that could, if not already, shake up financial services. On today's show, I'm interviewing James Neville, the CEO of Yaspa. He's also the former CTO of WorldPay. We get into how Yaspa is connecting identity to money, including applying that combo in the high-risk area of gambling. He is also very blunt about AI and gets into why the startup is expanding in the US. You won't want to miss it. Here's our convo. James, welcome to Money Isn't Everything. It's so wonderful to have you on the show today.
Thank you for inviting me.
Well, I was excited when I saw that announcement that you're coming to Atlanta, but we'll get into that in a minute because I want to set up the conversation of like Yaspa and how you're in all these hot areas of identity, real-time payments, open banking, and then also like it seems to be like cautioning operators and gamblers on if they're in danger while gambling. And I find that like just fascinating as a broad overview. But I wanted you to, start us off with like what is your focus today at Yaspa?
Okay. So, true to our original story, we're a business with our North Star is connecting identity and money. We are an instant payments business. And when we say instant, we mean seconds, not minutes, like as fast as we can possibly move money into an operator or a merchant and then the money back out to yourselves as a consumer. We are quite unique in that we combine identity and financial health at point of transaction. So you noted that just before that, we operate in markets where you need to know the person who's putting money on account. So you need to know that it's James from One Long Street, but equally it's very relevant in kind of highly regulated context. Gaming, you mentioned, there's anti-money laundering obligations. Where does James' money come from? How much money does James have? And actually, in the context of financial health, has he got enough money to put this money on site? Is he able to, in a gambling context, is he able to put money on account and gamble $10, $20, $50, right? And has his behavior changed over time? And if his behavior has changed adversely, then the operator should be able to intervene and say, like, just pause, James, you spent too much money here. And effectively, we empower the operators and the players, the consumers, to be able to kind of make those decisions in real time.
See, okay, this is so interesting to me. I'm just like imagining the practical elements of this, but how much data do you need to be like making these recommendations?
On the basic side of things, you need effectively a month training, right? Going back obviously gives you a bigger pattern, but in the US, you've got like unauthorized return. You've got all kind of flavors of kind of different returns that happen within the banking ecosystem. You can see chargebacks, you can see those from cards and from ACH, and you can see changes in somebody's income. So obviously, the longer you go back, the more you can see stability of income. But there's obviously a very different scenario if somebody's got a salary payment now, they're employed, versus somebody who's got agency or contract payments, and you want to see kind of going back as a stability of that kind of income stream. And all of the stuff is, I think you can think about it as a real-time view of a credit score. So, credit scores, the Equifax experience, they're building intelligence from missed payments and scheduled payments and credit cards and mortgages and loans and all those things. They can only see adversity or any problems with somebody's credit history once those markers of missed payments or late payments start to happen. And they don't really come on someone's record for a good month or two ahead of where the missed payment actually happened. So open banking and the way we've been doing it across Europe and soon to be the US is really about taking somebody's financial data in real time and applying kind of practical methodologies across that to say what's their financial health, very much like a credit score, but in near real time.
And for like the person who might have an addiction or is overspending, what makes them want to opt in?
So there's a number of reasons. So people opt in the gambling context, and certainly in anywhere where you have trading of any variety, really, you generally have limits. So even if it's a crypto, you're allowed to deposit this much money because we don't know your financial history, we don't know your financial health. So the kind of upside to a consumer is that I can get my limits raised. I can deposit more money at the start because I am qualified to put more money on account, but also they get away from the kind of random interventions that kind of stop them in their tracks. So Like typically in Europe, when somebody goes to a certain level, certain threshold of spending, whether it's an AML piece or whether it's a concern about, responsible gambling or putting too much money on a crypto account, the intervention is, please provide me your bank account. And at that point, you're like, oh, okay, now I need to go get a bank statement and scan it, upload it. Someone needs to look at it, make some determination over it. That takes a long time. That's not hours, that's days. So the upside for the consumer is, here's my transactional information. I don't need to be asked for it. You can just make that determination. So there's no friction in kind of intervention, whether it's in play training or gaming.
I think this is fascinating, and it seems to be more of a topic in Europe. Like I think I've seen some neobanks that are like, oh, I can stop you from like even making a payment at gambling. In the US, it seems a little bit free for all at times, but I know card controls are very much pervasive in the United States. And I guess I'm kind of thinking about the broader thing of like sort of like this friction or intervention or something. And I'm wondering, like, if we broaden it up a little bit, I mean, do you think more of this is going to happen in different ways?
Yes. So Europe's definitely pushing that direction. I mean, classically, you've got like the 7995 kind of card code that blocks people. So, certain merchants will block 7995 transactional deposits on account. The banking sector, the EBA is starting to mandate registration of merchants across payments, both recipients and kind of payers. So there will be a way of kind of building up the kind of sectoral view. Whether that leads to blocking or not remains to be seen. The US is obviously much more liberal around that side of things. And I think Europe's got, particularly in kind of the higher risk sectors, it's had an industry that's well established for 20, 30 years on America's regulation. You recognize that online gambling has only become regulated over the last decade, really, in the US. So Europe's gone further and it's started to talk about affordability regimes. So has somebody got enough money to put that bet on the football or not in real time? And then they've gone again a little further in places like the Netherlands, where they mandate limits. So you can only gamble €300 or €700 within a prescribed period. And of course that seems fine on the face of it, right? It seems like a lot of money, but somebody gambling €700 that's earning a €2,000 paycheck, it's quite a lot of money. But somebody that's earning a lot of money with disposable income almost coming out their ears, that seems like a really small number. So there's objectivity around what is somebody's discretionary spending capability and what's their freedom around that. The US has taken it slightly differently. So the kind of responsible gambling laws are kind of, they're weaker, but there is a view around financial health and what operators need to do to enable that. So a lot of this it's not box ticking, but it certainly doesn't have the kind of the stringent nature that a lot of the regulators in Europe are applying. But naturally, it will transition over time.
Yeah, no, I'm also fascinated because one of the problems that seems to be in the US and I'm sure elsewhere is just like the fintech apps. I know Robinhood gets criticized a lot, but for like making the game, like it feel like a gaming experience to like invest. So this is an interesting other example of like how to intervene.
I mean, everything's gamified at the end of the day, right? Everybody's trying to drive people to apps. And look, you've got the rise of, DFS, daily fantasy sports in the US. Prediction markets are currently predominantly offshore, but kind of polymarket and the like trying to come onshore. There's the whole heated debate, certainly in California, around sweepstakes and, what's a prize pick versus, kind of a consumer to consumer type sweepstakes. So there's all kinds of different layers of this that are slowly being unpicked by the regulators. But, again, the US sees this slightly differently to Europe. There's always been a kind of grey morality that surrounds the sector in Europe, whereas US is something legal, then it's generally embraced and it's an interesting kind of sector to play in. So we definitely see a different type of appetite in the States than we do in Europe.
You recently are setting up shop in Atlanta. Why now? Why US now?
Well, firstly, we raised money to do it, and I've been promising.
You got to stay true to your word.
Yeah, well, there is that. There's also like getting the team, but we had so much stuff to do in Europe and kind of building our our current business. And it makes more sense to kind of go into another market when you've already established a product and a set of customers that's semi-transposable to the US. But we see, the opportunity, the rise of, gaming, gambling in lots of different contexts. You also alluded to gamification generally across all those markets. That's a huge growth sector in the States. We've got a huge amount of confidence in working with the operators across Europe. So it's natural that we go over there. I mean, I guess personally, my wife's an American, so she's a San Franciscan. So like we are over there a while as well. It would have been San Francisco, but we ended up in Atlanta because I don't know if you know, but the old kind of the payment corridors were really Atlanta and Jacksonville were the two kind of big cities that the world pays and the FISs kind of concentrate themselves around. So, most of the Brits that want to come to America go, oh, it's New York or it's San Francisco. It's really sexy. It's a great place. But actually, the people that are really going to do the work for you if you're building a business are generally in those locations. So that's how we've ended up there. Atlanta's a pretty city. I liked it all the times that we've gone there. So that's become our natural home. I think the biggest company we share it with in the kind of SaaS space outside of payments is probably MailChimp. But there's a lot that's been kind of built around there. The Belt Road's really, really nice. So we will see how our time develops over there, but it's approximate to most places in the US. So that makes sense for us.
Oh, that's good, because I know some people it's such a pain just to make a simple business flight based on where they live. But you are arriving at a wild time in the US. I mean, the Trump administration and the CFPB, if you're just listening and not watching, there was an eyebrow raise. But also open banking, one might say, has been a bit under attack. Or another one might just say the business model is being sorted out. Most recently, Plaid and Chase made an announcement where Plaid will be paying Chase for data access. What that price is remains unknown. So I guess there's a lot to unpack there, but maybe to start with, how does it make you feel arriving at a time like this?
I mean, look, I've got the age on me, and those of you who can't see me, I'm half century gifted. So I've seen a lot of swings in administration over the years. And let's not make this kind of political because you can go one side or the other. But turbulence in lots and lots of ways. The world's changing massively, and the world dynamic of power has shifted massively over the last 20 years or so. So I think the kind of Trump mantra, or maybe the Republican mantra of kind of trying to, I guess, dilute the state, so to speak, try not to fund too many international organizations, and try to have kind of, I guess, a looseness around things. We've seen that before. The kind of open banking rule, it's good for standards. It's really good for standards if you've got that in place, but everyone's going to fight for the commerciality of the data that they're given. I think we look at the kind of history of Europe, this all really started from a European mandate, and also complemented by the UK trying to push for account switching being completely seamless. So we had two dimensions. We had one that was regulatory, very European driven, and one that was kind of competition and markets and consumer driven in the UK. The UK ended up establishing a body. The open kind of banking standards were formed from that, and it had a trustee with a mandate from government to make this stuff work. And it did, albeit it landed just before coronavirus and stalled for a bit and carried on. But Europe tried to enforce it by the regulatory dimension. Of course, what you get there is the pushback from people on the sharp end of it, i.e. the banks, going, we didn't really want to do this. We don't see any upside from it. It's costing us money in infrastructure, hardware, consultants, et cetera, et cetera. And, we over the years had some extreme pushback from banks when we questioned that they weren't compliant with the regulations. And they were like, effectively, we neither have the resources nor the inclination to comply. I guess that's a no. So US has taken it slightly differently in that even without open banking standards, there's a commerciality that it's cultural, right? You like making money. It's a capitalist heartland, shall we say. So the banks and the Plaids and the MXs, they've already made these relationships with banks. And in fact, if anything, they've made them pre-compliant in the same way some of the European businesses like Token made money making the banks compliant. Now, make of that what you will. Jamie Dimon asking for more money for access. That's a commercial push. It's very Trumpian. It's the art of the deal. So I think you'll see a little bit more of that, but they're already being paid by most of these providers anyway. So this is more of a, and it's my personal opinion as well. I don't know what Jamie is actually saying, so let's not be litigious about this. But, if people want to get more money out of a commercial agreement, then it's the art of the deal, right? So that's what everybody is pushing for. I think the standards and, trying to push that direction will make things easier for the aggregators. So the Plags, the MXs, the Acquires, the Finicities of this world. But we directly work with them. We're actually not doing bank integrations directly ourselves. That's not our business. Our business is in the value of connecting payment to the money itself. So yeah, it might lead to a bit of consolidation in that aggregator market, might lead to a bit of price competition. I mean, that all remains to be seen, but it is just divvying up the prize pot, I think, at the moment.
I like the way you put it there. And I'm wondering, in that Plaid announcement, it did say it wouldn't be changing pricing terms for its relationships that it already has under contract for like its fintech bank customers, et cetera. But I'm wondering, do you see this as like, I know a fear I've heard from people in the industry is like, oh, then it's gonna like all the fintech companies that didn't account for this kind of fee could shift their business model in this way or that way. And other people saying, oh, well, if they can't handle that fee, are they supposed to be existing
Yeah,
even?
I mean, look, that's just supply, demand, and price elasticity, right? Eventually, it will settle down. And from our experiences across Europe and across the US, the pricing models are pretty wildly different on both sides of the continent, and equally, there's a lot of differences in the US as well. So it'll harmonize. It may consolidate. I don't think it's going to freeze out the fintech sector. I mean, if you're someone like us, and let's just say our providers decide to increase costs by 50%, then that's going to have to come back on our merchants over time. But, that's just the nature of the market. It happens in Europe as well.
I also want to quiz you a little bit about like life as at a startup versus like a larger organization like WorldPay. I mean, what is that like for you? Or do you have a preference of which way you play?
I mean, look, I'm like 32 years in industry, and the first 10 of mine were in startups, and they were a lot more startup-y than the startups I'm in now, should we say. It was
Yeah.
two lads in a warehouse sitting on a cabinet rather than the chair. So, I've been all the way down there building businesses in my 20s. And, now capital is pretty abundant. I wouldn't say that we've, raised as much as some of the other fintechs out there, but it's easy enough to kind of find money if you want to scale. I mean, there's benefits to both, right? I like the randomness of every day, and I like the challenges. I like things going wrong and being able to fix them. And every day, and honestly, every day is a challenge here. So, but that again is, if you're in a large corporate, that gets masked. There's more people dealing with like micro challenges every day, and the politics increase and so forth. But the wages are good and the stability's there, and you're not staring into the abyss every day and thinking you're going to fall off a cliff backwards because a chasm opens up. But I think I've worked out over the years that I'm definitely not a corporate guy. As much as I was like CTO of WorldPay, that time there was make us more like this, do that, change the organization. You've got unfettered access to be able to do various things. So a lot of my career has been, intrapreneur and entrepreneur at the same time.
Yeah. Oh, that's really cool. And I definitely know that corporate life masking the problems or like someone presenting on a slide like this terrible stat, but it's like reframing it of like why it's still good, which is always
reframing in lumps like 10 other stats that everyone looks at before that one. Yeah.
a little bit of theater, a little bit of corporate theater. There's one segment of the show, and it's going to move us into a different subject, and that's what you said, and this is what you said on a different podcast. I believe it's a podcast, not an article, and it's tied to AI. And I think you were talking about Klarna at the same time, and when it had like pushback of like rolling out a chatbot and then firing a bunch of people and then hiring them back. And you said, I don't think that AI has really got that personal touch quite yet. And I'm wondering, no, okay. Let's unpack that a little bit more. Like what is missing? Let's illustrate that, or what's missing from AI for that personal touch?
It's a model. There's no humanity there. There's no abstract creative thought. It's a very clever premise that can string language and various other kind of aspects together in a series of tokens, right? It's predictability and things that have happened before, and it's a way regurgitating the same, as far as I'm concerned. So if you look at a lot of the AI art, it's everyone's regurgitating something that's based on some theme that's originally happened. I don't see a lot of originality there. I mean, you're not going to see the next Mona Lisa being like put in front of you from, an AI bot. And equally, I think, I had talked a bit on agentic AI before. I mean, I'd probably trust an agentic AI to go off and buy me a new hammer because it definitely knows what hammers are good, but is it going to go off and buy my next pair of sneakers? No, not really. Because, I think I said before, like, I like orange. So occasionally I'll wildly buy orange stuff, but it doesn't mean I want to wear orange every day. So you look at it from a tokenistic perspective, maybe AI goes off and buys me orange all the time. And I'm not quite sure if that's right. But I use ChatGPT all the time. It's good to pull together research. It's good to, do the drudgery. I, at the moment, would not get it to answer my customers because I just think it's a really bleak, horrible way of looking at the world. And I think Klarna saw that from its limited rollout. It's good for us in chasing things like RFIs and finding data from one source and putting it together with another and firing an email back or firing a Slack message. Things like that we use all the time in ops, but I'm not putting it in front of customers right now. I truly believe in people and customer service. So
there was a term that's been trending this week called work slop, like saying this Gen AI problem is causing this work slop. And they mean it like in memos, decks, writing code, to your point of like unoriginal, also like causing another employee a lot more time to have to deal with it.
Yeah. I haven't seen a lot of it in our organization yet. I saw I had one of my sons over to do a marketing kind of internship. He's only 14, so he came and did a kind of marketing kind of run through. He really enjoyed it. But there was one slide in there, you could just tell it was AI workshop, if you want to call it that. And it's so obvious. I mean, it is so obvious when somebody does that. Because you can look at people's language, you can look at how people structure stuff. You know when they've copied stuff straight out of ChatGPT. 100%.
Yes, and it has this odd upbeat tone. But is that pendulum going to switch, do you think?
Yeah, I mean, look, it's got its usage, but, you're starting to see marketing being dominated by, AI content web and, historically SaaS businesses and financial businesses are all built on connectivity and backlinking and, build your content web and get likes and so forth. And you legitimize yourself for SEO. That's happening at broad scale now, but like what's going to happen with, ranking some of this stuff, Google and its friends or whatever search engine it happens to be, or it's Perplexity or whatever, is going to know if that's AI generated. So does that push your rating down or does that push your rating up because it's backlinked more?
Oh, that's a good question.
I don't know the answer to it, but I'm sure they're all thinking about it.
Yeah, I'm sure they are all thinking about that. Well, James, there's one more road I want us to go down because it's another hot topic, stablecoins. And there's a lot of hype on it. And then you're seeing like these stablecoin things popping up in the US all the time, almost every week. And I'm wondering, what's your position on game changing for financial services? What are the consequences for banks, or how are you thinking about it?
Yeah, so I mean, look, we're not a bank, so banks probably think about it in very different terms to us, but the kind of fiat rails, the real money rails, they've been dominated by the SWIFTs, the faster payments. You've got ACH in the US. They all take an element of time, right? And the settlement itself is an agreement of messages between two parties. Yeah, I think whether it's Ripple, whether it's Circle, whether it's any other party that's creating USD stable coins or Euro stable, whatever it happens to be, you've got to ask yourself, why would you send money over those rails? If it's like a 20 euro payment, you're not enabled for sending USDC, then I kind of get it. But if you're doing large cross country, cross border monetary movements, why would you do SWIFT over holding a wallet in two places? And then you've only got to worry about fiat on and off ramping. I mean, one use case, I spoke to one of my friends in the Philippines who's building a business, and obviously there's a lot of concern about local currency fluctuation as there always is in kind of the emerging economy. So people always want to hold US dollars, but the local banks won't give you a US dollar account, right? They want you to hold local currency. So the obvious answer is like, pay me in USDC. I hold USDC. So then the next extrapolation of that is anybody that's non-Filipino, or Filipino that doesn't live there anymore, sends their money back in USDC locally, and then somebody can do whatever they wish with it from there. And there's all kinds of OTC provision. So I think like cross-border is probably is currently the first point of attack, and in emerging economies, it's probably helping to stabilize the kind of US dollar hegemony that's been in place for many, many decades. USDC is the most dominant stablecoin, right? So, we've got Circle released Euro equivalent. I see less uptake of that in Europe than I do in USDC.
Oh, interesting.
There's lots of regulations around all of this. We've got VASP in the UK or MICA across Europe. They're quite hard licenses to get and hold.
Mm-hmm.
I think, once the US really establishes its kind of regulatory framework around it, I think you'll see kind of everybody just kind of moving in that direction. I think USDC as a common method of settlement and payment will become pretty pervasive in the next 5 years.
Well, I was going to ask you what you're expecting in the future, and you just lined it up. I just have one last question for you, but before that, if someone wanted to reach out to you, what's the best way, or any last thoughts on, financial health and transactions and opportunities there?
So I'm always happy to talk to people in industry about what their take is, and particularly around how consumers view this kind of stuff, like whether it's intrusive, whether it's positive. We always try to spin it as a positive. I'm out there at Yaspa. You can find me on LinkedIn, send me a message. Always happy to chat. We'll be in Atlanta soon. I'll be pretty much based there for the majority of next year. So come knock on our office on Peachtree Street and say hello. And any other questions, just find one.
All right, well, lovely. And my last question for you, James, is what is the image on your phone's lock screen?
It changes every 10 seconds, and it's set up as portraits of my children and my dogs at the moment. So one day I'll get a dog, and another day I'll get my daughter, and another day I'll get my older son.
So the heavy hitters. That's lovely.
Yeah, indeed.
James, thanks so much for being on Money Isn't Everything. It's been a joy to ask you about a bunch of different things in banking. So thank you so much.
Brilliant. Thank you, Mary. It's been lovely to have me here.
Okay, so one thing I learned is the upside of challenges. In his words, I like things going wrong and being able to fix them. If you enjoyed today's Money Isn't Everything episode, make sure to hit that follow button on Spotify, Apple Podcasts, YouTube, or wherever you're listening. I've got more great combos coming your way, including up next, where we'll be exploring debt collection and the attempt to make it more enticing. Yes, you heard that right. Catch you then.